In this lecture, we're providing a brief review of Chapter 5. Chapter 5 relates to evidence and documentation. Keep in mind that our role as an auditor is to express an opinion of the financial statements based upon our audit. The audit itself is based upon how we interpret the documentation coming from management. The first thing you want to think about is the relationship between the audit report, the financial statements, and the actual audit. Management is responsible for the financial statements. We've talked about this. Management completes these financial statements based upon management assertions. We'll talk a little bit more about management assertions in a few minutes, but keep in mind that the management assertions are the explicit or implied assertions related to components of the financial statement. The auditor completes audit procedures based upon these management assertions, and these audit procedures are based upon evidence provided by management. The auditor interprets this evidence, reaches a conclusion, reports in the audit report the opinion of the financial statements, and this audit report then is embedded in the financial statements, and hence we have the audited financial statement. So let's talk about management assertions. These assertions relate to the implied and explicit statements of management related to activities and account balances within the financial statement. Now you notice that we have assertions related to transactions. Transactions are the things that take place on a day-to-day basis. These are things like revenue transactions, expense transactions. And we're looking at these from the perspective of completeness. Is the items that are reported, is that a complete list of the items? Occurrence. Every transaction that is reported by management, management is implying that these transactions actually occurred. Cutoff relates to the end of year balances and making sure that the transaction occurred during the period that we're auditing, and not a transaction, as an example, that took place in January that we're reporting in December. Authorizations relates to the fact that any transaction that took place is a result of management's authorization of this transaction. Accuracy is self-evident, and of course classification is, are we reporting these transactions as in the appropriate classification? The other piece of it relates to assertions about account balances. Now, when you think about account balances, you want to think about the balance sheet. So in the account balance, what we're looking at is we're looking at existence and completeness. Now, you notice that these are complementary items related to the same balance. Existence is stating that the items that are reported on the balance sheet actually exist. So if we're reporting a fixed asset, we're stating that that fixed asset exists. Completeness relates to the fact that everything that actually should be reported actually is reported in the balance sheet. Now you notice in the balance sheet that we use existence and completeness. I'll go back one slide here, and the same concept occurs related to occurrence and completeness related to transactions. So they are the two concepts that relate to transactions as well as account balances. Rights and obligations, we certainly are concerned with the items on the balance sheet that we actually have a right to these items. As an example, inventory may be there, it may exist, but we may not have rights to these. Maybe they belong to someone else. Valuation, allocation, think about accounts receivable. Accounts receivable is the net accounts receivable. What's being reported on the balance sheet relates to its value, and its value relates to the value that we are setting up in our contra account of the allowance for doubtful account. And then finally, we have assertions related to presentation and disclosure. Accuracy, occurrence, rights and obligations, completeness, classification, and understandability. And again, make sure that we understand this, is that what we're looking at is we are auditing based upon management assertions. Management assertions are these items that management is asserting about the financial statement. So our activity as an auditor is to actually test these assertions. So we're testing assertions related to transactions, we're testing assertions related to account balances, and we're testing assurances related to the presentation and disclosure. So how do we do this? We do this through audit evidence. So what is audit evidence? Frankly, audit evidence is everything from whatever source used by the auditor in arriving at the conclusion on which the audit opinion is based. Audit evidence includes things like documentation, observations, inquiries. Anything that we're getting from the client is embedded in what we're looking at related to evidence. So we consider evidence related to the nature of the evidence. What is the nature of this evidence? Is it sufficient and appropriate? And then we go through this process of actually evaluating the evidence. Sufficiency relates to the quantity of the evidence. The greater the risk of material misstatement requires a higher quantity. So in our sampling process, what we're saying is that the greater the risk, the greater the amount of material that we actually review. The higher the quality of the evidence, the lower the quantity. There's actually an inverse relationship between the quality of the evidence and the quantity of the evidence. So the higher the quality, the less evidence is going to be required. One of the things that we want to consider related to evidence is the fact that we are not going to be convinced related to the evidence. Why are we not being convinced related to the evidence? That is not our goal. Our goal is not being convinced because, frankly, we don't have time to be convinced. We're not looking at perfect evidence, and we don't have unlimited time to review this evidence. But the threshold that we're looking for is being persuaded. So we're being persuaded rather than convinced in forming our opinion. And there's two reasons for this. One of which is that we need to complete the audit in a reasonable time. The second is that in many cases we are relying on evidence that's not perfect. But as long as we are getting persuaded that the evidence is appropriate, then we are able to form our opinion. The appropriateness of the evidence relates to the relevance and the reliability. The appropriateness is a measure of the quality of this evidence. Quality of the evidence, some things to consider. Is it coming from an independent source outside the entity? Are there effective internal controls within the organization so that as we're considering this evidence, we're considering this from the framework of a strong internal control process? If the auditor has direct personal knowledge of this evidence, perhaps it's test work that the auditor is actually completing, then this is a highly reliable evidence. Documentary evidence and original documents also increase the quality of the evidence. As we're evaluating the evidence, what we're looking for is we're looking for the type of evidence that's available. We want to relate this evidence to the actual management assertions. The auditor should be thorough in searching for evidence so that he or she can come up with an unbiased evaluation of this evidence in the process of forming an opinion. We've talked about this, but I want to bring this to our attention yet again related to the process. So you notice that in the risk assessment process and the test of controls this is where we are assessing the risk of material misstatement. The test of controls is primarily focusing on processes. So the primary test of controls is where we're looking at assertions related to transactions, because that's the process. Revenue transactions, expense transactions. These are the things that we're looking at so that we are validating that internal controls are appropriate. Our substantive procedures, these are the procedures that we use to actually form our opinion. In our substantive procedures, we are measuring monetary misstatement as opposed to measuring the risk of material misstatement. In our substantive procedures, where we are measuring monetary misstatement, is we're primarily focusing on account balances. Now, we will talk about how that we do dual testing so that we're actually looking at the same process in relationship to test of controls and substantive procedures. But we need to understand conceptually that when we're looking at test of controls, we really are looking at transactions. And when we are looking at substantive procedures, we are measuring monetary misstatements in the actual account balances. This is a very good slide, and I want you to spend some time on this related to how we're actually testing either transactions or account balances. Now, you notice here that we're looking at transactions because we're looking at occurrence versus completeness, but the same thing occurs related to existence and completeness. So you notice that we have on the one side, we have the journal or the ledger. We have the recording by management of these transactions or elements within the account balance. And on the other side, we have the source documents, documentation that actually justifies that the item exists or that the transaction was actually completed. When we are looking at occurrence, we're taking a sample from the journal and vouching that that transaction actually occurred from the source documentation. So as an example, if we're looking at a revenue transaction that was recorded, we would be looking for, as an example, the fact that it was shipped or the fact that the transaction was actually paid. That would validate or vouch the fact that the transaction actually occurred. If we're looking at assets, we're looking at a fixed asset in the account balance, we would actually take a sample of those fixed assets, search for those, and if we actually find the fixed asset, that would vouch the fact that that item actually exists. Tracing is the opposite direction. Here what we're looking for is we're taking a sample of actual transactions, maybe shipping documentation, or if we're looking at fixed assets, maybe a sample as we're walking through the organization, identifying fixed assets, and then we are tracing those to the journal or the ledger. So what we're looking for in completeness is we're making sure that all the transactions that should be reported are actually reported. So I hope this short video helps you in terms of understanding what we're looking at related to audit evidence. I'm looking forward to our next discussion, and thank you very much for your time.